Hey, good morning, everybody. And I hope you had a wonderful weekend. It's beautiful, peaceful, serene, uh, and now get ready for the rain for the next few days. And I'm going to pummel you with announcements this morning and uh, pummel you with class material. And, you'll feel like you've been in you can't hear me. So is anybody else having difficulties hearing me?
I can hear you.
Okay, great. Thank you. I appreciate the feedback. That's wonderful. So John, you need to check your speakers or something. Uh, so anyway, you're gonna feel like you were in the proverbial um, uh, ring, getting beat up. Uh, Apparently, John. Let me see. Somebody typed a message. Let me see. It's funny that I would tell John to check his speakers and he can't hear me. That. Yeah. Anyway, that's me. So. So here we go. We've got a bunch of announcements. I've got a bunch of material to cover, and some things about Thursday's class. I want to get you. I'm gonna get you as much material as I can based on what's due coming up, and I want you all to get started. So here we go. Homework 5, so numbered, although it's like the 6th or 7th or 8th homework. Remember company analysis, it's due tomorrow at noon. And if you've waited until the last minute to start, you might be scrambling. And I encouraged you long ago. And some of you I know have been working on that, and that's great. Anyway, it's due noon tomorrow. Don't forget. So I have posted, as you should have seen, 2 videos on the business plan project that I've discussed briefly in class, and well, maybe a little more than briefly. At any rate, it's 2 videos are posted about that. A bunch of documents are posted on Canvas in the files under the folder. I don't remember what I called it. Project, business plan project, class project, business class project plan. I don't know. It's you'll find it. It's there. Several documents with contents, what your contents need to be, due dates. The first one of which is next Monday at midnight. And what else? Expectations. And in there, you should know I'm an English stickler. And and one thing I didn't mention in those videos that I'll just mention here. I know that there are some who are who might have grown up. If in learning English you learned the Queen's English, British English, there are a lot of different small differences between American English and British English, but I'm an American English guy because that's where we are. And so some of those differences, you may or may not be aware of these. It's good trivia questions, perhaps. Like, how do you spell judgment? Well, in judgment, in British English, there are 2 E's in that word, and in American English, there's only one. In American English, the judge, take the E off and put ment. and in British English, it's judge with the E at the end, and meant. Um, Punctuation, commas, and periods in British English go outside closing quotes. In American English, they go inside closing quotes. Stuff like that. Little goofy things like that are, you know, uh, and it isn't just because I'm old. I've been doing that stuff for a long time. It's just really weird to pay attention to stuff like that, but I do. So I'm a stickler. So that's part of the expectations is that you write well, and that it not be your first draft. Uh, the first drafts are generally poorly written. Mine are, and you need to go back and edit once or twice or three times. I've got a new book. I'll have to finish it before I tell you it's a good one to read. But so far, it's really good on Antonin Scalia, and the number of times that he and his colleagues edit their work is amazing. So anyway, so all that business plan stuff, the videos are out there. It's posted. Uh, do not delay. Do not delay. You
I've got
want
a
to,
few questions about the videos. I've watched both of those so far.
okay.
And I had a few timing questions with that. So I know that the first submission is due Monday at midnight. And in those videos, it says that to create a quality piece of work, it's going to be like, I think you said, 6 hours per number. And 3 of those are due on Monday. I mean, that's like almost 20 hours of work due in like 6 days.
Your work on that will be total to the time that it's completely due on December 8th. My estimate of the time of about maybe as many as, I can't imagine it taking that much, but as many as 5 hours would be 15 hours. And that would be a little bit heavy for 1 week, but that 5 hours per is, you're going to turn in your first draft next Monday of the first 3 sections. Your first draft of the next 3 sections will be due the following Monday. And the final version is due December 8th. And the final version is my estimate of 5 hours total for each section. If that makes sense.
Okay. Yeah. And then with the Monday due date over the weekend or the week of Thanksgiving, it's just a lot to get done with all of us trying to travel home because we're not supposed to be on campus past next Friday. Because we don't come back to Blacksburg. I was wondering if maybe you could work with us on that one.
Probably. Sure. Okay. I'm a reasonable guy. Yeah.
We all have to travel home because they technically don't want us back after Thanksgiving.
That's right. Yeah. And I had forgotten about that. I know they didn't want you back. I hadn't. Yeah. So anyway, yeah, we can work with that a little bit. And regardless of when it's due, I didn't want to put it off too long, so that here's my fear. And typically everybody tuned in for class, as you are right now, doesn't have this problem to the extent that some of the other students do. And that is, just waiting till the last minute. And I just want to make sure everybody has a chance to get a very good score, because there are too many who will wait until the very last minute and they won't edit their work. And because of what they turn in, they'll be disappointed in their score. So those due dates were a little earlier than even I would have wanted, except I wanted to make sure everybody was getting something done. So sure, Garrett, if you want to, ship me your ideas, I'm happy to listen to any alterations you think might be appropriate. and everybody. I mean, I'm just because one person brought it up doesn't mean he's the only one that gets input. So you all can let me know. Send me an email. I'll be glad to listen to what you have proposals. I can't promise I'll listen to everybody. I will listen to everybody. I can't promise that it will make uh, what changes will come about because of it. Only because I don't know what you'll suggest. I don't make promises like that. But we can alter it. I'm good with that. Okay. And by the way, Garrett, thanks for looking and getting through there and thinking about them. That's wonderful. So bottom line, don't delay. You can start thinking about this and jotting down notes and making progress way early, and then put it together at the end. Okay, today we're going to finish discussing. Well, actually, even start discussing taxes. We're going to go through taxes pretty quickly. Project cash flow. And we're going to move through that reasonably quickly. That's chapter 12 in your text. It's again like some of these items. These are the text is really really covers this material very well, and so we'll talk about chapter 12 and we'll breeze through that pretty much. And I want to talk about construction economic indicators. We're not likely to get through that at all today. We may not get to it. I hope we get to it. And if we don't get to it, well, it'll be the next item on the agenda. Excuse me a second. Go off screen. I want to get that economic indicators and our next, our topic for Thursday. I want to get that to you as quickly as possible because of the squeezed up time that I've given you for this business plan. And I realize it's a squeezed up time. So because of that, I want to get this stuff to you as quickly as and effectively as I can. So here's the plan for the remainder of this week. Whether or not I get to economic indicators, that's the next item on the list. And after class today, I'm going to be preparing to present the next video, not preparing the video necessarily, but by tomorrow morning, I will have recorded Thursday's class video and posted it up. So Thursday, we will not meet at 8 a.m. I'm going to be, I will be on at 8 a.m. on Thursday to answer any questions you have. So Thursday's going to be, if you want to join the class Thursday morning, it's just, I'm not going to present anything new. I'm just going to sit here like a bump on a log and answer your questions. I will post Thursday's class material by Wednesday morning sometime. It'd be early Wednesday morning because I've got some stuff going on. Actually, I've got to leave. I'll leave home about 9-ish Wednesday morning, so it'll be posted by then. So reiterating, all of Thursday materials and maybe a little more will be posted by tomorrow morning. And then Thursday class will be a question and answer session. I'll be here. If you want to come, fine. If you don't want to come, don't worry about it. I don't think there'll be anything. There won't be any new material presented anyway. So that's the plan. And the schedule for today and allegedly Thursday. Okay. let's move on if we can, and we'll move on to taxes. Boy, my screen is full all of a sudden here. Okay, let's talk about taxes a little bit. This is pretty much where we left off last Thursday. In your organization, you will have to pay taxes. And we've already talked about unemployment taxes. We've talked a little bit about Social Security taxes. These are income taxes. There, of course, is a separation between what's a corporate income tax and personal income tax. Why would we be talking about personal income tax, except it's interesting for us personally? Well, many of the companies that you might form are going to be taxed at the personal rate. LLCs are taxed at the personal rate. Sole proprietorships are taxed at the personal income tax rate. S corporations are taxed at the personal income tax rate. Pardon me. Don't worry about these terms, S corps and C corps and LLCs and LLPs and all that. Don't worry about that. You don't need to know the details of those. They're just different ways of organizing your business legally, as far as the government's concerned. So at the corporate level, you pay your corporate income tax, and then the people who are paying their income tax, right? So and because of the accounting in a corporation, since you deduct the salaries and benefits from your income before you pay taxes, that money allegedly needs to be taxed at some level, and so it's taxed when it goes to the individuals who receive it as income. Your dividends, if you have stock and you issue dividends, or bonds and you pay dividends, those are you pay taxes on that. On the personal side, personal income taxes it's a different tax rate. It's a different tax structure. Currently, it's historically been very similar. Currently, it's not quite as similar. And we're going to be talking about both of these different tax systems, if you will. So obviously, you have your taxable income. If you look on your income statement, you've got taxable income, and you subtract things that you get all your revenue, if you will, and you subtract things that are deductible, that are tax deductible. Depreciation, right? Reduces it's an expense. It reduces your tax burden. On a personal level, things that are used to run your business are tax deductions within certain sorts of limits. And that's, you need a good tax accountant. There's no two ways about that. You can do your own taxes now, pretty straightforward, but once you start a business, do not depend on yourself. A good tax accountant, whatever you pay them, typically you save in your tax burden, because they know exactly how all this stuff works. And you don't want to be caught not reporting proper income for some reason, because people have gone to jail for that. So you don't want to do that. Not all costs that you incur are tax deductible. That's why you need these good tax accountants. The 50% on meals, you take somebody out, you're trying to market yourself, you're trying to build your business, and you buy someone lunch. Well, you can't write off the whole thing. Used to be you could. There are limits on charitable donations from a business perspective, and losses and gains. Again, the specific words and the details, don't worry about it, just get the big picture here. What's a passive loss and a non-passive gain? Don't worry. You can carry losses forward. That's a good thing. So those losses can help you in the next tax year. There's the IRS lets you carry several things forward from one tax year to the next, and that's so that's a very helpful thing. The one thing that you may not think about that you need to think about are that you pay your income tax quarterly. On a personal level, when you're a student or even a young employee at a business, you don't have to worry about paying your taxes quarterly because the company handles that for you. The company takes taxes out of your check, right? Your monthly or biweekly check, and those are already taken out, and those are collected up and then sent to the government. Well, when you start your own business and you start earning income during the year and you need to pay taxes on that income, you need to file those quarterly. You need to submit your taxes quarterly. I'm no great independently wealthy individual, but I pay quarterly taxes. In the past, usually it's because I owed money and they say, hey, we should have had this money earlier, and then they start you paying on a quarterly basis. So you need to keep that in mind. Not only do we worry about federal taxes, we have state taxes. So the current federal rate, it's the same in 2020 as 2019, is a 21% flat tax rate for corporations. So this used to have many, many brackets, and we'll talk about tax brackets in a little bit. And the rate used to be quite high, but and you can see there in 1909 was when they first started a federal income tax. But anyway, so you've got the federal rate, so you're going to pay 21% flat rate there. And then depending on what state you're legal in, where you've established as a company, you're going to be paying tax rates in that state. So let's pick some. Missouri, where I'm from originally, 6.25%. Kansas 7%. Texas 0%. Virginia 6%. West Virginia 6.5%. Pennsylvania 10%. New Jersey 11.5%. So that mounts up after a while. So if you take the 21% flat tax rate, let's say, and then you add the state rate on it, let's say you're from New Jersey and you want to go back home to Jersey, so you'll be paying 32.5% income tax. That's the rate that you'll pay on your net income before, obviously before taxes, and then you pay your taxes. So that's the rate that you'll be paying. And of course, there's these other taxes we've talked about, but this is strictly on the bottom line, right? In 2019, I believe 2020 is the same. Again, these, if you're organized as a sole proprietorship or an S corp, or so in some situations, you will be taxed at the personal income tax rate. So those corporate taxes, interesting, but may not apply to you. These would apply to you, and you can see that this is a bracketed marginal tax rate system. And so what does all that mean? All that means is that you will pay, no matter how much money you make, right? How much your income is after expenses and all those deductible items, tax deductions that you might have. You know, if you buying a truck and you're depreciating the truck, all that stuff still gets to show up if you're organized as an LLC, for example, and you're paying at the personal income tax rate. You still get to do all those things. So have no fear in that regard. But no matter how much you make and no matter how much your taxable income is, you will be paying taxes like this. Okay, if you're, let's say you're, let's do the unmarried individuals because we've got the three different categories going on here. Unmarried individuals, married individuals filing joint returns. That's you and your spouse file them together. Or head of household, a little different definition, taxable income. So let's look at the unmarried individuals here. None of these numbers are anything you need to memorize. Don't worry about it, or I'm not going to ask you a calculated tax question ever. So if your income is over $9,700, so for the first $9,700 that you make, you don't pay any tax on it. Once you make you're up to $10,000, well, you will pay 12% of the amount that's over the $9,700. So let's say you made $10,000, so that's $300. You would pay 12% of the 300, not of the whole 10,000. 12% of the $300. So that's what, $36 you would pay in taxes. Okay, now if that's up to $39,475. Now so all the money that you earn between $9,700 and $39,475, all of the money you earn in that bracket is taxed at 12%. Now, all of the money that you earn in the next bracket between $39,475 and $84,200, all of the dollars earned inside that bracket are taxed at 22%. So it's a different tax rate, right? So you still pay 12% over the first few dollars, and then you pay 22% over the next few dollars, and then you pay 24% over the next few dollars, and then 32% over the next larger chunk of dollars. So each of the dollars you earn in that particular bracket is taxed at the rate in that bracket. That's why it's called a marginal tax rate. These are marginal rates right here. And these, so these marginal rates are applied only to the dollar amounts within those particular brackets. And you can see that it's graduated. So the US income tax system has long been, if not always been, a progressive tax system. And that is, the more you make, the higher the percentage of your income you pay in income taxes. So when you get out here to 37%, I mean, you're making a lot of money. That's a lot of taxable income. This is after all those tax deductions, right? However, you're paying 37%. And remember, so let's go back to being in Jersey. So you're also paying the New Jersey tax rate, 11.2%. So you're up to what, 48.2, almost 50%. Almost 50 cents of every extra dollar you earn goes to taxes. And that's why some people argue, if you've got these really high marginal rates at the top end, it reduces the incentive for people to do more, to produce more. And anyway, that's an argument. And so there's your brackets, and you pay. The brackets sets are a little bit different depending on if you're married or not, head of household or not, single. All that is, government figuring out how all this stuff works. So don't ask me how they came up with these numbers or why the breaks, where the breaks are. It's all to try to make it come out right, whatever right means. Okay, so we've got the corporate tax currently flat rates, likely to change. I mean, this stuff changes. It doesn't change with the wind because it's hard to push through. But there are high tax politicians and low tax politicians, and since this was constructed under President Trump a few short years ago, if with a new president, we don't know who that's going to be yet. Still up in the air. This could change. It could stay the same. Who knows? You have to keep your eyes open and watch for it. And you'll watch for it, and you'll see it coming. Okay, let's talk just briefly about capital gains tax. I talked about capital gains before. Remember, capital gains is when you dispose of or sell an asset for more than its original, what's called the cost basis, or purchase price is what we use. So if you sell an asset for more than you originally paid for it, that's called a capital gain, and these are the capital gain rates. And again, it depends on how you file, and there's only really two brackets here, and you'll notice that the capital gains tax rates are lower than what we call the earned income brackets. So this is to promote investment. They want you to invest your money, and investing your money would earn you some capital gains. Your money is working, and it's not earned income, so you're taxed at a lower rate. People argue about capital gains. Also, we'll save that argument for another day in the interest of time. So we have marginal or incremental tax rates. It's the tax rate depends on how much money you've made, and it's on the very next dollar that you earn. The rate is applied to that. You apply the capital gains tax then when you're disposing of an asset, and that's when the capital gains tax is calculated. There have been in the past also differences in what's called long-term capital gains and short-term capital gains. And short-term is like, you're stock trading, and you buy a stock and you sell it in a month. That's a short-term capital gain, taxed maybe at a different rate than a longer-term capital gain, where you keep something for an asset for more than a year. So that's out there. Again, this is that's not particularly as relevant. That's stock trading is not relevant to what we're talking about here. And we've talked about depreciation, talked about it one last time, and that is these tax savings that you get because you have an expense is spread out over time with depreciation, as opposed to coming all at once. If you're able to expense an item, you would rather, for tax purposes in general, again, the accountants I'm sure could give examples that are contrary. Um,
I have a quick question.
sure.
So I have a question on the money being taxed. So let's say that you have a business bank account and you
Sure.
have over like $10,000 in that business bank account. Is the best bet is to make sure that you invest that money back into your business instead of keeping it in your bank account so that it won't be taxed? Um,
Uh, good question. Good question. Excellent question. First of all, you're not taxed on the money you have. You're only taxed on the income that you earn. So once you've earned that income and it's in an account somewhere, you're not taxed on that money yet. That would be called a wealth tax. And and people have talked about it, and uh, that would be a wealth tax would be a tax that's applied to any asset that you have. So money in the bank, home you own, it's how much you're worth. They would tax you based on that. Um, Now, whether or not you take money and invest it in your business, or maybe leave it in the bank in an account, uh, that's really strictly a business decision, and wouldn't be uh, well. We could get we could get pretty deep here, but that money that you I apologize. I'm gonna ramble for a second here. When you have money in an account, you want to put that money to work. So if you have $10,000, you want to put that money to work now, because you don't want to let it. Don't want to have it sit idle. You can put it to work by just leaving it there and having it earn interest, which is a loser proposition. You want to invest that somehow. So you either put it in some sort of safe, maybe market instrument like treasury bills. That's a zero risk option, something like that that at least gets you a little bit of return, or you could be risky with it. I mean, you could invest it with a friend, right? Who's got a bang up business, and it's growing, and you might loan them some money for a while with a promise that you're going to get more back later. Riskier, right? So, or you can invest it back into your own business, and you'd invest it into your own business because you think that that influx of that $10,000 is going to grow your business and produce more income for your business, maybe short term, maybe long term. So you always want your money at work. You want to have it earning you income, and it's the income that it earns that you're going to pay your taxes on, not the actual amount itself.
Thank you.
Yeah, did that answer your question way too much?
No, it was great. I
Maybe.
appreciate that.
Okay, sure. That's really a good question, because everybody's going to be facing that issue. All of you will be facing that issue. I have some money here. What do I do with it? And that's a real challenge. Um, and since we're going to be talking about cash flow next, that really comes into it as well. And because cash flow is king, as they say. So we'll talk about that here in just a little bit. Okay, so there is such a thing called tax credits. And credits, if you do your personal income taxes, this is strictly a personal income tax thing, to the best of my knowledge. Don't quote me on that. Not an accountant. So you have tax deductions, which reduce your taxable income. And then after you calculate your taxable income and you calculate your taxes, then after that, there's such a thing on the personal side called tax credits, where it's actually a reduction directly in the tax that you owe. So it takes, okay, I owe $4,000 in taxes this year. Well, this tax credit would reduce that. Maybe you've got a $500 tax credit for education. So now you only owe $3,500 in taxes. Maybe there is a child care tax credit. I never got to take advantage of it. I don't know how much it is, but that would further reduce the actual amount of tax that you pay. So that exists, and you can see on the IRS webpage, there's a picture here of that. Some of these, there's something called a saver's credit. Don't know what that is. Earned income tax credit. There's your education credits. I've taken advantage of that in the distant past. Small business healthcare credit. So if you run a small business and maybe you're filing as on the personal side, maybe you're an LLC or something, you're a small business and you're paying healthcare for some of your employees, you can get a credit somehow for healthcare. So and maybe if you've got a company car, you get a plug-in electric vehicle credit. There's everybody's looking, everybody wants to influence the tax system, and so the electric vehicle collection of, their organization has gotten this credit passed. So all of these are going to be important to you, and you can just see, one page of IRS, tens of thousands, hundreds of thousands of web pages. You can already see that you really need an expert to help you do that. And finally, we've got this thing called an alternative minimum tax, and the AMT came about, and they thought some people were somehow were paying less tax than they should, and so this is a way to make sure it takes essentially kind of eliminate some deductions. If you're taking advantage of the tax system, the perception is that you're taking advantage of the tax system for your benefit, which we all do actually. And so there's another way that they'll calculate your tax that actually increases the amount of tax you pay. So you have to watch out for the AMT, which means you have to plan ahead. And because the AMT will jump up and bite you at the end of the year and it's too late, if you plan ahead and you project your income tax, which is what your accountant will encourage you to do, then you might be able to organize some of your cash flows to dodge some of these issues, which means you're still taking advantage of the tax code, which is exactly what you should do, because you should not pay any more than you're legally bound to pay. Now, if you have some philanthropic desires and you want to pay more, you can always write a check to the IRS, or I'll let you pay my taxes, and that'd be fine as well. Okay, enough about taxes. There's a lot to know about taxes. What should you know? I would like for you to know that as a going concern, you may be paying the corporate tax rate or an individual income tax rate, depending on how you're organized as a business. I'd like for you to know that. I'd like for you to know that if you're paying on the personal level, at least in 2020, if you're paying on the personal level, you'll have to know the individual tax brackets, and your tax will be calculated based on marginal tax rates. And it's a progressive tax system, so that the more you make, the higher, not only the more tax you'll pay, that's certainly the case. That would be the case with a flat tax. The more money you make, the more tax you pay. But the progressive system is that the more money you make, the higher the rate at which you pay taxes. So the higher percentage, the more of each dollar you will pay for taxes. You need to you should understand that as well. And you should know that there are tax credits, and there are you pay taxes on your income minus tax deductions, and that's your taxable income. And once your tax is calculated from the taxable income, you can have tax credits, which reduce the tax burden on you based on some very well-defined tax credits. And in many ways, they're there to help those who are a bit perceived to be, and I have no reason to doubt that, at some disadvantage. So, single parents, small business, things like that could use a boost. And then, so that's this AMT. It's important that you know about it. I'm not going to ask you about it on the final or anything. So, so that's what you should know, basically, about income taxes. Now that we're very taxing to talk about those, let's take a short 5-minute break, and we're going to come back and zip through cash flow reasonably quickly because I think it all makes sense. But we will talk about cash flow in relation to the earlier question as well. So let's take a let me see, I got to get my producer. Let's take a 5-minute break. So at 8:51, we'll crank back up again. Very brief break. So cash flow. Let's talk about cash flow for a little bit. Cash flow is king, and if you this is a a word of warning, and this is for when, and I'm going to assume that you're all going to start your own outfit. Now that's not true. I know that's not going to be true, but we need to operate on that. And this is really true in your personal life too. Actually, although in your personal life you can, there's some other mechanisms, but cash flow. If you don't pay attention to your cash flow, if you're not on top of your cash flow, you will go under. There's no question about it. Cash flow, adequate cash flow is necessary. You can be incredibly profitable and go out of business because you didn't manage your cash flow. And you can have great ideas, and if you don't manage your cash flow, you won't make it. Certainly, on a personal level, your cash flow, if you're employed by somebody, it's your whatever your salary is, and you know that you don't pay beyond your means. Now, many people get deep into debt. You could do that as a company too, but pretty soon lenders stop lending you money, and you don't want to live that way. You do not want to live personally or professionally, in business, at home. You do not want to live with debt hanging over your head. So cash flow is very, very important. Now there's in the textbook, page 165, the first example. I generally don't like to do something like this, but I want to just read this example problem to you. So payroll due to the employees on a project is $10,594 for the week of May 12 through May 18. Okay, so you owe your employees $10,594 for that week's of work, May 12 through 18. The employees will be paid on May 21st. So you have to write checks. You have to have cash available to pay these employees on May 21st. The construction company can bill the owner for this labor on May 31st. So think about this. You're paying the employees $10,594 on May 21st, but you're not going to bill until May 31st, and will be paid for that labor on June 25th. So you've got net 30, for example. Net 30 is 30 days. When you submit that bill to the owner to receive those funds back, the owner has 30 days to pay you. So you paid on May 21st, $10,594. You receive the money for that on June 25. How long must the construction company fund the labor? Well, that's the May 21 through the June 25. So the math is pretty stinking simple, but it's $10,594 cash that you have to float. You have to handle this for those 35 days between when you paid them and when you get paid. So you have to have that much cash on hand. Now think if your payroll is a little bit higher, and maybe it happened at a different time before you could bill, so that may stretch out to 40 or 45 days. And this isn't the only thing that you're paying for, right? You also have regular bills that come in. You're paying utilities, you're paying fuel. You may have payments, borrowed money on equipment. And all of this has to be paid in cash. So you can see that, I mean, this is a simple case, but you can see that you got to have the cash. So we're going to talk about cash flow. This is chapter 12 in the textbook. It's like I said at the start of class, it's very well done. And you could probably just read through the text. I may not add an iota or an iota, depending on if you say it right or not, of assistance here, because this chapter is certainly an exceptional chapter. Talk about cash flow, and remember, you've got cash coming in and you've got cash going out, and you want this bucket here to be full of water so that you can go for a while without replenishing the bucket and still be able to pay the requirements when you open the spigot and money starts flowing out, because you owe money for materials, you owe subcontractors, you owe your labor, like in this example. So that's very important. Okay, now the cost of work. You know that this is the proverbial S-shaped curve. There's S-shaped curves in everything. It's a pretty pathetic S if it's an S-shaped curve, but that's what they're called. And most all construction projects follow this. Many things in life follow this S-shaped curve here. And this is, your costs are going to accelerate more quickly at the very beginning of a project, and then they'll stabilize, and then at the end the amount of excuse me, value that gets added is starts decreasing. You're just closing this thing out, and maybe in a residential, you're doing you're painting and putting down flooring and stuff. It's the closeout kind of stuff. But they all pretty much follow this this cost pattern. And this isn't considering profit and overhead and all this other stuff that goes on. But that's pretty much for a project what the cost looks like. Now, so you incur these costs, and what about payments? Well, you've got suppliers, right? And you need to pay them. And typically, hopefully, you pay your suppliers on a very specific monthly schedule. In some months you may owe them nothing, and some months you may owe more. But you have a schedule set up so that these aren't random events, right? You have schedule for when you pay your suppliers, and you know ahead of time how that's going to work, so you can plan for it. This cash flow is all about it's all about cash flow, but to manage it properly, it's all about planning. And this is a real challenge. This is part of the job that might be just tedious, awful, tedious work. You may wish that the only thing you had to do when you ran your own business was empty your own trash cans. This can be tedious, but it's critically important. And what about subcontractors? What are the contracts are like with them? When do you pay them? What about retention? You want to make sure that you withhold retention to the extent possible. I see a question here. I will answer that at the end of class, since it's about the homework. I'll do that. So you have to plan all that sort of the payment stuff, and it's going to be choppy. So your payment curve looks something like this, right? You get little payments along the way, but you're going to make big payments periodically, hopefully according to a schedule, when you will make your payments, because it's nice to draw these nice continuous curves, but nothing happens continuously in the construction business. It's there are a lot of discrete points in time where events happen, and in this case it's payment events. And you sit down on a Saturday afternoon sometime when you prefer to be watching a ball game, and you're writing checks, right? Or you're on the computer making payments to your suppliers, and it's a big chunk at a time. Okay, so we've got these three, I would call them concepts, or three realities going on here. So you've got the value of the contract work that you've done, right? This is you could say percentage of work completed, right? Would be another measure of value, and this would include everything. So the value includes the overhead, your profit margin, all that kind of stuff. You also have the costs going on, and the costs are without the profit and overhead, and payments from the owner. So you have receipts and you have payments going on, right? That's the cost picture, but the cost picture is choppy. You know, it's not that nice S-shaped curve. And you have the payments from the owner. So it looks kind of like this. It's never going to look exactly like this, but it looks kind of like this because we don't have the choppy payments in here for the cost. Notice that, remember, the costs don't have P&O, the profit and overhead. But notice that the value does include those things, and so it's going to be a percentage above cost, and that's why it starts out, you know, very small when your costs are low, and you can see that it grows pretty uniformly because there's a constant percentage difference between value and cost all the way through this curve. And then, of course, here are you know, the receipts of payments that come along, and at the end you get the big chunk, you get the retention, all that from the owner, all of that shows up like that. So you can see that your receipts, unless you can contract it you're better than anybody I know, your receipts are always going to lag. The receipts lag the cost and the value. They just always do, because you don't bill until the work is done, and after the billing, there's a period where the payment, you know, net 30, for example, can come, and so it's going to lag. It's going to lag sometimes as much as 2 months, 3 months. There's going to be a lag here, and you have to make sure that you have the cash to handle that. Okay, so what about cash provided? It's a difference between the payments and the receipts, and you need the cash. We've covered this. Needed to pay for this stuff while you're waiting on the money to come in. So you need that cash hoard, almost, if you will. You don't want too much cash, because that's not putting your money to work. That's like carrying around extra cash in your pocket instead of having it invested in something. And maybe at this point you don't care, it's not enough. Maybe I don't care because I don't have enough money to care about the nickels and dimes and dollars that money could be earning. In your business, you need to, it's going to make a difference. So the cash provided by the contractor is that delta. So it's if your payments are this top guy here and your receipts are the bottom part, all these gaps here, you know, if you're big into calculus, we could do the area under the curve thing, right? And eventually you're going to get all as well at the end, but all along the way you need to fill in these gaps, and you need to have the cash to fill in those gaps. Okay, there's a gosh, what is it? 4-step project cash flow determination. You need a cost loaded schedule, so you should have you should know what your costs are going to be and when those costs are going to occur, This is not perfect. You're not going to know exactly. Things are going to change in your project. I understand all of that, but therefore you adjust your cost loaded schedule. You don't just ignore doing it because it's going to change and it's difficult. So you adjust it as time goes on, and included in there, you can determine when costs are going to be paid. So how often do you pay your labor? Is it weekly? Is it biweekly? Typically, you can't go more than biweekly, and more typically, it's weekly. Okay. What about the payments for materials that you have coming in that you've acquired for the project? End of month, maybe. I mean, whatever the schedule is, you need to establish that. What about when you're paid? Do you talk set it up so that when you pay it withholding, holding retention, or paying retention? So is it a subcontractor? Is it someone that you need to wait until completion of the job so you hold the retention, or is it you're paying Lowe's for a bunch of lumber and there's no retention there? You pay that. Then you determine when you're going to receive the payments from the owner. So when are you going to bill the costs, and when are you going to be paid for the costs? We've seen in our accounting stuff, the balance sheet activities, that when you count something as income is not when the cash flows for the income, right? We've got our accounts payable and accounts receivable and all that sort of stuff. So you need to plan for the schedule for when those payments are coming in. And if you take your cost loaded schedule and you look at the payments coming in, you've got your difference, right? You've got that little sliver. Sometimes it's much larger than a sliver. You've got that area under the curve that indicates that you're going to be paying out cash before you get paid back. And that cash required then is that difference. You can calculate that difference. Now, in graphic form, this is interesting to see. It doesn't look very helpful. And in fact, in graphic form, it's only helpful to see how you're doing, not necessarily helpful to do it to get the job done. And that's why spreadsheets, right? So you'd put all this in a spreadsheet with timing, so you can do your calculations and see how much cash you're going to need. So it turns out that when you receive payments at the end of the month, and the maximum amount of cash you're going to need is during the month, and it may even, usually it builds up because, okay, I pay this week, I pay next week for my labor, things like that. So somewhere maybe closing in on 2/3 of the month is when you're going to need your max cash. And enough said. There's a description of some of that in the text that's described. That's pretty good. But that makes sense. I mean, that's logical. Your expenses are going along, and you're not going to get paid for a while. So there's just an example here over the months of cash invested with progress payments. So here before the progress payment, you're here, and after the progress payment at the end of the month, after the progress payment has been made, you're here with your cash. So you're negative cash, right? This is you're still going to be negative even after those payments, and you're going to be way negative before those payments come in. So you can see here in the fifth month, you're at negative $20,000, a little over. So you would need that much cash that month. You'd need that much cash available to pay all your expenses before this payment comes in. Once again, useful graph to look at and see where you stand. Not helpful necessarily for building it. Now, if you don't have progress payments and it all comes in at the end, you're going to accumulate all these cash payments that you have going on. And so you can see that you need a lot of money, a whole lot of money. Now, some of this may come from borrowing. Certainly there's not a restriction that you can't borrow money. But remember, the more you're indebted, now you've got extra payments, right? Regular scheduled extra payments that you have to make. So you want to be very careful about that. And I would urge you not to get there. How can you reduce the amount of cash that you need? And you can, if you use subcontractors, you pay them when the job's done, and you can immediately bill them. Let the subcontractors take care of the labor and all that sort of stuff. So you're contracted to pay a chunk at the end, just like the owner then would pay you at the end. So this can reduce the amount of cash that it's required of you that you need to have on hand. You could reduce the retention rate, so that you get more. You've got more in your pocket. You can always increase your profit and overhead markup. Now, the overhead markup is maybe a little bit differently than what the overhead actually is. This is a game. We're not going to get into that, but you can have an overhead markup that covers profit included in the overhead markup, as well as then your profit. And if you increase that, certainly that's going to create, when you get paid, that creates a larger chunk of money that you can then hold in reserve for cash for future payments. And if you increase the value of the work early, so you get big chunks of money early, then you have that cash to kind of carry you through. So that's another method you can use to reduce the cash required. There are pitfalls with all of these, right? There are pitfalls. And finally, table 12.1, which is where is that table in your book? It's page 169. It's just an example. Example 12.3 is a really good example for kind of looking at the actual cash flows, basic cash flows through the project. Okay, we are out of time. And I need to answer, do you want us to provide page source with our homework number? Page source. I'm not sure exactly what you mean, Itana, by page source. Oh, that's to me privately. I'm sorry, my bad. I'll get back to you in an email and answer your question in an email. Okay.
Do you want us to provide the links, like where we find the quick ratio and everything? Do you want us to provide the LK10, K10, and?
Yeah, for the definitions of the ratios, you do not need to include anything, but I do need to have some sort of reference for the 10K or the annual report, whatever it is that you're able to use for the company.
Okay, thank you.
Okay, yeah, you bet. Okay, so everybody, another video coming up to replace, remember, Thursday's class. I'll be here to answer questions, but that's it. I'm going to go ahead and post all the video material for Thursday's class before, it may be tomorrow morning, but it'll be early tomorrow morning, or it may be yet today. Economic indicators and the next topic in class. So that's coming. I'll put some announcements and stuff up as well. Enjoy the rest of your day, and I'll be back in touch.